Hitting seven figures in revenue doesn't guarantee that you're going to have any money in the bank. Let's break down why big revenue often hides big cash flow problems and how to fix them. Hey, it's Steven, your host of the Savvy or Surrender podcast, and I'm excited to share this episode with you. First of all, it's officially our 10th episode, which is awesome because apparently like 83% of podcasts never even make it past their first 10 episodes. So I'm excited about that. If you have found any of these episodes helpful, or if this is even your first episode, I would love it if you would like, subscribe, share, and leave us a review. I'd truly appreciate it. All right, so let's dive into today's episode. And it might sting a little, I'm going to be honest, because it's going to be in the best way possible, of course. It's called, Why is My $1 Million Service-Based Business Broke? And trust me, if you've ever looked at your revenue and thought, where the heck is all my money going? This one is for you. Now, here's the thing. You're not alone. I've sat across from many business owners with big numbers on paper, seven figures, even a couple that were in the 8-figure range. In revenue though, in gross revenue, but almost nothing left in the bank. And they ask me, where is it all going? So that's what we're really going to dive into and the mistakes that I have found that people do. So today we are unpacking how you can have financial success and instead of being broke and what you can do about it. So the one big issue, the illusion of success is, I'm gonna start this with a little tough love, but revenue doesn't equal profit. And I know a lot of business owners, they don't quite understand what that means. So you can make $1 million a year and still be flat broke. You can have a packed schedule, a full crew, trucks on the road, and still be wondering how you're gonna cover payroll next Friday. You probably have been there, at least if not now, at some point in your business career. You've been there, I'm sure. I know I certainly have laid awake, during the payroll week. We pay every other week. There have been times I'm wondering how I'm going to make payroll on Friday. What business is going to come in that's going to cover that, right? Do I need a working line of capital? Can I get something quickly? We've all been there. And the thing is that most of the time you're measuring the wrong thing. You're chasing top line revenue instead of cash flow and margin. And there's a saying that I love. It's revenue is for ego, profit is for sanity, but cash flow is for survival. So if you're in business just to say that you're doing seven figures, you've already surrendered, number one, but the goal isn't to impress people. And you've probably already figured out that revenue does not equal the cash flow, right? You know this at this point. Especially if you're hitting jobs, if you're doing larger jobs, if you're just service-based and you're changing water heaters and you're getting paid very quickly and you don't have a large accounts receivable, that's great. But if you're working larger jobs, maybe you're working with a general contractor that pays once a month, new build, commercial, something like that, that's where the cash flow can really get tight. And so we want to build something that pays you consistently, supports your family, and buys you freedom. So let's break down exactly what happens and the issues that come up. The reason number one that I found is overspending on growth. And I've been exactly here. So you're finally starting to make some money. So you buy equipment, trucks, hire a bigger team, get an office. Both of those things I did. And you tell yourself, we're investing for growth. It's okay. It's kind of funny. Business owners will quit a 9-to-5 job that pays them consistently and usually a lot of times pretty well to start a business that they work from 5 a.m. to 9 p.m. now instead and will pay less. They pay themselves less because they believe that this business, this entity that they created, their baby, needs the money more than they do. And so now they're strapped for cash all the time because they keep putting it into the business. I want to show you a way where you put your own money in the business one time, and then after that, the business feeds itself and pays you consistently and makes a profit. That's the whole key there. You'll tell yourself, we're investing in growth. But here's the problem. You grew your expenses faster than your profit. And so when cash gets tight, you're working for your vendors, your staff, the IRS, pretty much everybody except who? Yourself, right? You're not doing the right things to pay your family. So how many times have you seen this in other businesses? I remember a business, a restaurant called Boston Market. Man, I loved their food. They had great turkey, chicken, things like that. I think there was also another one called Kenny Rogers Roasters that was very similar. But Boston Market, they grew very aggressively, at least at the time we were living in Los Angeles. And they were just everywhere. They opened one up by my house, and we'd go there. We'd get like the whole family meal, and you'd get turkey and macaroni and cheese and mashed potatoes and gravy. And it was really, I thought anyways, it was really good food at the time. They were everywhere. And then they weren't. And what happened was they grew so aggressively that and many of the locations didn't work, but they had to put so much tenant improvements into the buildings and into the restaurant and staff and all those things that come with starting a business. They did all of that so aggressively before the money started coming in that next thing you knew, they were broke and they filed bankruptcy and they started closing all of the locations. A more recent example is Mattress Firm. I remember reading a case study about how brilliant they were. They were going to be the Starbucks of mattress stores and have one on every corner. Here in Boise, we literally had them across the street from each other. Like you had one right here and one right there. Who buys a mattress that often? The problem, I don't know about you, I don't buy mattresses like I buy coffee, right? I buy coffee a couple times a week. I don't buy mattress a couple times a week. In fact, in the 25 years of our marriage, I think we've bought a couple of them. So they don't work the same way, right? So you don't want to overspend your growth. The second reason is poor cash flow management. So you're watching your bank balance instead of your cash flow system. And that's like driving a truck while staring at the gas gauge and not the road. Without a plan for how every dollar gets allocated, it's gone before you know it. And that's one of the main reasons why I teach, one, the Profit First system, right here with the book Profit First by Mike Michalowicz, but also then cash flow and the savvy path to cash that I'm introducing. Let me continue following the analogy with the gas gauge and looking down the road. As you drive down the road, do you know what signs to look for? I'm thinking speed limit signs, warning signs, stop signs, yield signs. You get the point. Just like when you're driving your business, your cash flow systems has signs that you should be looking for to make sure that you get down the road safely. Think of your car's dashboard as your business dashboard. Yes, we want to look at the gas gauge. That's important, but so are the other gauges. We're going to get into those metrics and gauges in a bit. But so we want to be looking at everything, right? Now, reason number three is underpricing and overdelivering. You're amazing at your trade. I have no question about that, but you're afraid to charge what you're worth. And so you price jobs to win the work. Meanwhile, your materials, labor, and taxes are eating you alive and you can't figure out why. Your customers are happy, but you're exhausted and underpaid. Man, do I know this one. So I have a thing in my business that I call the Savvy Ritz. And it's something that I use with my team. It's mostly just an internal thing that I'm letting you guys in on a little bit. It's my desire to provide 5-star service to my clients. And think of it like the Ritz-Carlton, right? Savvy Ritz-Carlton, or flying first class. Up until recently, I've been trying to provide first-class service while charging budget airline prices. For example, I recently went to San Antonio and for a workshop, and I have flown first class. It is wonderful. You get drinks before you take off. You get your choice of drinks. On the way to San Antonio, I flew Southwest. On Southwest, you get a little cup of a drink, and now they have graham crackers. They used to have peanuts. They finally figured out peanut allergies are bad. So, that's what you get, right? And you get one thing along in that, and you don't get that until you're like an hour into the flight, right? I'm sure you've probably flown something similar to that, you understand. Some airlines, you don't even get that anymore. What was it, Horizon Air or no, not Horizon Air. I don't know. One of the other budget airlines. I flew to Vegas. It was cheaper. The seat to Vegas was cheaper than if I took any luggage, including a carry-on. Like the seat was like $39. I feel like I was on a lawn chair, but anyways, you get the analogy. I was providing first class service and on budget pricing, or at least the emphasis was I was trying to. So what I quickly found is that I cannot provide the level of service and have the level of staffing needed for that service while also charging budget airline pricing. So I had a choice to make. I could either increase my prices and give the service that I've wanted to give, or stop thinking that I could be all things to all people. And so I made the decision to charge for the service that I feel like clients deserve, knowing that I'm ultimately going to be able to, by doing that, I can provide them a return on investment where maybe I'm charging a little bit more, but it truly is an investment, and they're going to be able to make more money off of my service and therefore be able to afford flying first class. Reason number 4 is you're reactive on taxes. Remember, these are all reasons why you're doing $1 million and still broke. You're reactive on taxes. You treat taxes like a once-a-year event. You go, you meet with your tax professional, you don't plan, you don't save, and then April hits you like a gut punch. And if you owe $40,000 and you didn't see it coming, that's not the IRS's fault. That's a lack of planning. And just a little inside information, I remember I was probably 13 or 14, somewhere around there. And I remember my dad just coming back from his CPA, and which is kind of the reason why I got into the accounting business, actually, was because of his CPA. I was fascinated with what he did. But anyways, that's a different story. So my dad comes home and he's telling me how he's going to have to pull $20,000 out of his IRA, out of his retirement account, to be able to pay his tax bill. At the time, I just thought, man, that sucks that you have to pay that much in taxes. What I didn't really think about was if his CPA had been doing his job and being more proactive, maybe, or if he had been using the profit first system, which obviously wasn't around back then. I mean, we're talking like, 35, 36 years ago, something like that. But had he planned something like that, he wouldn't have had to raid his investment retirement account to be able to pay his tax bill. The money would have already been there. See, the wealthy, they plan for taxes all year. You need to start doing the same. When I meet with my clients every quarter throughout the year, I'm doing that because we are planning for our tax bill or their tax bill at the end of the year and what we can do to, one, maybe minimize it if that's what the goal is. Depends on what the end is in mind, right? What do you want to accomplish in the next year? But also, at least if nothing else, it's not a surprise. And they've got the money in the tax account. We've set up profit first. We've got the money in the tax account to be able to help them to pay for those taxes in advance. So reason number 5 of why you're making $1 million a year, but you're still broke, is because you have no financial clarity. And what that means is your bookkeeping is behind, your reports don't make sense, and you can't make decisions from chaos. If your books are a mess, your brain will be too. And so if you look in your QuickBooks and you don't understand them. You don't understand the financial statements. That's fine. That's some training. You can learn those. But if your bookkeeping isn't up to date, if you're not getting categorized and reconciled, if they're not matching, if something's off, clean books equals clear decisions and confidence. So when was the last time your accounts were reconciled, or if or even categorized? Do you have them in the right categories? If QuickBooks and the checking account are not close, then do you at least have an understanding of why they're not close? And if you don't know what I'm talking about, you jump into QuickBooks and you can see where there's the checking account number and there's the QuickBooks number. And those usually are not exactly the same unless it's an account that doesn't have a lot of activity. But usually they're off a little bit because there's different transactions running through. So it's okay that they're not exact, but you want to know why they're not exact. You want to know that there's something coming in or out of the account that's making them be a little bit off. But otherwise, they should be exact. Like your savings account that only has 1 or 2 transactions a month probably, that should be the exact same. If they're not, something is missing. When was the last time your books were reconciled so that the checking account is matching what's showing in QuickBooks so that you know that all the transactions are correct? If that hasn't been done, looking at your financial statements and trying to run the metrics on it is pointless because you're working with bad data. So number one, you got to get good data. When reviewing your income statement, do you compare one period to another, like this month versus last month, this quarter versus last quarter, etc.? Do you calculate the gross profit percentage, expense to income ratio, net income percentage? Those are 3 ratios that would be fantastic for you to follow. If you track job costing, how close was the actual to the estimate? And do you review why you were off and how off you were? How often do you review these things? Weekly, monthly, quarterly? Have you ever done it? I ask because it's very common for business owners to tell me they don't look at their numbers, which is also why they don't value bookkeeping services. They don't see how looking at your financials can help you grow the business, but then yet you're always broke. So while you do all those things, or maybe you're not doing those things, maybe you're not looking at the financials, yet you continue to put gas in the car, right? You're putting money in the business, and maybe, just maybe, we need to stop and let's do an oil change. So consider this your oil change. Here's how we're going to fix those issues. Those were the issues why you've got $1 million business and you're broke. Now let's figure out how we're going to fix it. And we're going to do it with the Savvy Fix, profit systems that actually work. All right, so let's shift gears. Here's how to stop being broke at $1 million and start running like a CEO. Now, step number 1, let's adopt Profit First. Let's adopt this book. Stop waiting for profit to magically appear. Pay yourself first. Set up separate bank accounts for profit, owner's pay, taxes, and operating expenses. So altogether, you'll have 5 accounts. And even if it's only 1% at first, it creates a habit of profit. So do this every week. Now, I know in the book, if you read the book, it talks about allocating on the 10th and 25th. It calls it the 10-25 rule. And that's fine if you want to do it. But for me to create a true habit, I recommend, especially for contractors, to do it weekly. And, again, unless you're working on big jobs that you only get paid once a month or something, then maybe it makes sense. But otherwise, if you pay weekly, or maybe you're a realtor, then you could do it every paycheck or, every closing that you have. That's fine. If you don't have closings every week, then every time you have a closing, go ahead and do your allocations. But I want the ultimate goal here is to know your real numbers. So step 2 is to actually know your real numbers. Your bookkeeper's job is to record history. Your job is to understand the story. So what you need to know, what is your gross profit margin, and compare it to different periods. Is it going up or down? Is it changing? What's the trend? How much of every dollar goes to overhead? What is your true expenses? And one thing that you can do is look at all your different operating expenses. I find that a lot of these are wrong. I want you to look at all your different operating expenses and determine if they are fixed or variable. Now, what that means is, here's the one rule. If you did not make a sale would you still have the expense? So officer salaries, employees' salaries, office staff, things like that, those are fixed. You still have them. But maybe commissions or materials or subcontractors, those are variable. You're only going to have a commission to pay if you have a job. If you make a sale, you're only going to have to buy materials. You're only going to have subcontractors. Anything that's truly variable, where it would only exist if you had the job, that should go above the line in cost of goods sold, and it should be part of the gross profit percentage. Then I want you to look at your operating expenses and determine what you have there. If you don't know where you're at each month, then you're just driving blind. Step number 3 is to stop buying growth. Don't hire, buy, or expand without a clear return on investment plan. Every asset that you have in your business, including employees, should have a return on asset. It should be making you more money. If you're buying a new truck, it should make you more money. If you're buying a new piece of equipment, it should be making you more money. If you are getting new employees, hiring somebody new, adding on to staff, it should be to make more money. So ask yourself, will this generate profit, or is it just going to be more headaches? And if it doesn't move the needle on profit, it's a vanity move. It's purely ego. Oh, I've got 10 guys. Oh, I bought a new truck. If it's not going to make you more money, then why are you doing it? Step number 4, schedule money meetings. Wealthy business owners review their financials at least every month, and you should too. Sit down for 15 minutes once a week. That's really all you need. And look at your numbers. Pull the latest P&L and look what came in, what went out, and what's next. And then step number 5 is to build your cash cushion. Profit first will help you get there, but your goal is to have at least 3 months of operating expenses in reserves. Cash buys freedom, cash buys peace of mind, and cash keeps you in control when everyone else is panicking. And the real talk here is what got you here is not going to get you there. Congratulations, you've got $1 million business. Now, here's the challenge, though, with all of that and with the cash flow is obviously there's going to be ebbs and flows. There's going to be slow seasons, which is why you have the 3 months of cash flow buildup. But if that's not something that's possible, then look at a potential line of credit. If you do a cash flow forecasting model or have your cash people, your money people, your bookkeeper, accountant, CFO, whoever it is, to build you a cash flow forecast where you can see where there might be some challenging months. You've got more expenses than you have income coming in. That's where you want to be able to utilize that line of credit, or you have that money in the bank to be able to help you withstand those slow periods. So there's a stage of business where hustle gets replaced by habits. If you're still running your business on adrenaline or deposits, it's time to evolve. And the difference between $1 million operator and $1 million CEO is simple. Operators chase the money and CEOs control it. And the moment you shift from chasing to controlling, that's when you actually start building true wealth. So if this episode hit home for you, if you're making money but never feeling like you have it, if you look at your profit and loss statement and you look down at the bottom and it says net income is $200,000 and you don't have $200,000 in the bank and you're wondering where to go, that's where I want you to take my quiz at savvytaxstrategies.com/quiz. It's find out how profitable you are. It'll tell you exactly where your cash is leaking and what to fix. So go to savvytaxstrategies.com/quiz. And then from there, I will also get you the first core chapters of the Profit First book right here. So if you don't already have this, it'll give you those core chapters. And then you can also book a Savvy Path to Cash assessment at meetwithsavvy.com, where we're going to map out exactly how to go from broke and busy to profitable and predictable. Because making a $1 million in your business does you no good if you have no idea where it is. So that's exactly what we would be able to map out for you. So meetwithsavvy.com. Love to meet with you. And thanks for listening to this episode, officially episode number 10. I'm super excited about that. Again, please like, subscribe, share, review, all those things. I would greatly appreciate it. Even if you just leave a quick comment that says, hey, Steven, fantastic episode. You're amazing. I appreciate you. Hey, I would love it. I'd love to see the comments come in. Promise I'll reply to you. And I reply to every single comment I get, mostly because I think I've only gotten one, but I'm just kidding. No, I'm not. I've only gotten one comment so far in a video. That's okay. We're building this channel. We're only on episode number 10. See you next Wednesday where we drop our next episode, episode number 11.